We are the Group 7.
And our topic is all about
International Financial Reporting Standards.
So what is IFRS? IFRS or International Financial Reporting Standard are a set of accounting standards that govern how particular types of transactions and events should be reported in financial statements. They were developed and are maintained by the International Accounting Standards Board or IASB. The purpose of International Financial Reporting Standard is that IFRS are a set of accounting rules for the financial statements of public companies that are intended to make them consistent, transparent, and easily comparable around the world. The following are the benefits of IFRS standards. First, IFRS standards bring transparency by enhancing the international comparability and quality of financial information, enabling investors and other market participants to make informed economic decisions. Second, IFRS standards strengthen accountability by reducing the information gap between the providers of capital and the people to whom they have entrusted their money. Last, IFRS standards contribute to economic efficiency by helping investors to identify opportunities and risks across the world, thus improving capital allocation.
So what are the impact of the IFRS? After controlling for firm-specific characteristics such as size, growth, opportunities, risk, and audit quality, we found that adoption of IFRS contribute to less earning manipulation, in which lower magnitude of discretionary accruals, more timely loss recognition, and greater value relevance of earnings and books values. Impact of IFRS to financial statement. Compared to Indian GAAP or generally accepted accounting principle, revenue under IFRS will be lower, and earnings before interest, tax, depreciation, and amortization will also be lower. As a financing component will be recognized as interest income, IFRS will require companies to make significant new disclosure. What is the difference between IFRS and GAAP? IFRS versus GAAP in overview. The International Financial Reporting Standards or IFRS, the accounting standard used in more than 144 countries, has some key differences from the United States Generally Accepted Accounting Principles or GAAP. At the conceptual level, IFRS is considered more of principle-based accounting standard in contrast to a GAAP, which is considered more base rule. So there are some differences between the two. At the conceptual level, International Financial Reporting Standards or IFRS is considered more principle-based accounting standard in contrast to generally accepted accounting principle, which is considered more rule-based. Under the GAAP, once inventory has been written down, any reversal is prohibited. While under IFRS, write-down of inventory can be reversed in the future. So key differences. IFRS is a principle of the standard-based approach and is used internationally, while GAAP is a rule-based system compiled in the US. Another thing about GAAP stands for Generally Accepted Accounting Principles and is the standard adopted by the Securities and Exchange Commission in the US. Except for foreign companies, all companies that are publicly traded must adhere to the GAAP system of accounting. The best way to think of GAAP is a set of rules that companies follow when their accountants report their financial statements. These rules helps investors analyze to find the information they need to make some financial decisions.
IFRS has four principles: the clarity, relevance, reliability, and comparability. IFRS defines revenue as the gross inflow of economic benefit resulting in an increase of equity accounts, other than direct equity contributions made by the owners. This leads to differences in how sales, service, and deferred revenue are recognized and reported. The adoption of IFRS to every business is beneficial to them because IFRS standards give transparency by enhancing the international comparability and quality of financial information, enabling investors and market participants to make informed economic decisions. The standards provide information that is needed to hold management to account. Just like in India, all the stakeholders can benefit the transparency, accuracy, uniformity, and comparability of the reported financial information by the companies.
Greater comparability advantage. Companies that match some standard to prepare the financial statement can be compared to each other more accurately. This is especially important when comparing companies located in different countries, as they might otherwise be using different rules and methodologies to prepare the statements. This increase in comparability is help investors better determine when their investors' dollar is globally accepted disadvantage. The United States has not yet adopted international financial reporting standards, and other countries continue to hold out, as well as make accounting by foreign-based companies that do business in America difficult, as they often have to prepare financial statements using IFRS and SIP using American generally accepted accounting principle. More flexibility advantage. IFRS use a principle based on philosophy, means that the goal of each standard is to arrive at reasonable valuations, and that there are many ways to get there. Standards manipulation. Disadvantage. There is a downside to flexibility that IFRS allows companies can utilize only methods they wish to, allowing the financial statements to show only desired end result. For example, changing method of inventory valuations can bring more income into the current year profit and loss statement, making the company appear more profit enabled. Increased cost. Disadvantage. A small company should be impacted by a country adoption of IFRS is the same way a larger one would. However, small business do not have as many resources at their disposal to implement changes, and the trends up.